more investors, tuned into equity. Maybe that is something we missed as an industry. So with, Prashant and Naren being the big boys, I think they should focus, and it's best to put pressure on them rather than on me. So
I think, Prashant, you do write newsletters, right? I've read a couple of them in the past. Just to carry forward the point from Anup.
My point is not to propagate some trends, but to generally talk about investment philosophy.
Investment philosophy.
So, if you look at Howard Marks' letters, it is not about saying that X will go down or bank rates will come down or, crude oil will come off or whatever. I'm not.
Why don't you write? Because, there's so many
I wish I had the,
time.
No, it's not time. It's more to go to a talent. I mean, if you don't know how to write properly, then you can't write that style, unfortunately.
No, I think you're being very modest, because the kind of feedback that I've got is that, people have followed a lot of your investments and they would love to.
No, but I think that's something
from you.
We as an industry need to, really, go and up our game on. We are too specific. What we write is mainly to propagate our funds. Or our performance, or, try to say that, why we've not done well. But we don't write to make people to come into equities, which should be the more larger goal.
Prashant, is that criticism justified? And how do you respond to that?
It's not criticism.
No, it's a constructive criticism. It's a positive. It's a positive criticism. At the end of the day, the idea here is to give more to the society in terms of the knowledge, and maybe impart that more to the audience. Prashant, how do you stand on that?
I think he's partly right, though I don't agree with that entirely, because I don't think, we seldom show fund performance actually. As a HDFC mutual fund, we have always sold equities. If you look at our communication, if you look at our road shows, unless someone asks for it, and that typically happens when your performance is not up to the mark. That's the only time we speak about performance. Otherwise, I don't recall having shown performance slides ever, whenever we are doing very well. And I think whatever commentaries we have written is always about why you must invest in equities. And I think you can go back and check our track records. But I agree with him that it can be done more. If 10 people start doing it, I think it will have a greater impact.
Okay. All of you here are great role models to a lot of people like us, with the kind of wealth you guys have generated and with the kind of returns that you've given to shareholders. But I think what a lot of us would like to know, and I'd like to start with you, Naren, is who your mentor or guide or role model has been through the years of your equity experience, and if there's been one or two key learnings that have helped you wade through your career.
I think the period till 2007, we used to think that if we understood bottom up, you would always make money. And 2007-8 brought me that feeling that you have to go both top down and bottom up. So that broadened, and thanks to internet today, you're able to read what Howard Marks has written, or James Montiero has written, or Michael Mobison has written. And the advantage that you get by reading the global people is they don't have any biases on India. So, the bias factor goes away. So you can see how you can use their theories to Indian investing. And that, I think, has been of great help in navigating markets over the last 5 years. But they also say you can't go right always. And to explain to all the distributors you won't go right always is not an easy job. So that is the flip side of it. But I would say that internet has transformed the way our ability to read what is happening, and the kind of ability that we get today, the kind of information we get is phenomenal.
So you spoke about some global names, but is there any Indian investor, value investor, guide, mentor who helped you shape your life, in your initial formative years that you've learned from?
As I mentioned, the group definitely helped me to see what happens is there are years like 99, 2000 and 2007 when the markets go irrational. That point of time, how do you hold your rationality? And for that, you need a support group. You can call it whatever you want, but there are periods of time when you need support of people, because you think the market is irrational and the market will punish you. During that time, how to hold your balance?
Okay, we have just about 2 minutes left. So Gopal, the same question to you. Who has been the biggest influence in your career so far?
I follow Peter Lynch very closely.
Okay.
And his style of stock picking and value investing is really the, the guidance for me throughout this journey.
Okay. Anup Maheshwari, what about you?
I think it's a whole range. There's not one thing. There's just so much to learn from so many people who've had so many years of experience. So it's a wide range, but finally you have to just get comfortable with your own style. I think that's critical. If you get comfortable with the way you manage and then you stick to it, I think that's the best rather than trying to, everybody has a style of their own as well. And the more you try to deviate from it, the more mistakes you're likely to make. So I think read a lot, but finally go with your own style.
Okay. Anup, what about you?
So there's a saying in sports which says, if you are a fan of a sports star, you should love his game and not the person.
Yeah.
So I think we should all do that. You should, love the game and not the person. And most of the examples that we see of the US really aren't appropriate for India because they have reached, because they are a very different society. They have a different way of looking at investment. We are just starting to build that phase. So, yeah, I would say that, focus on the game and not on the person.
Okay. That's very interesting advice. Prashant?
I think I have benefited a lot from lots of people, but I think two people who specifically come to mind is Mr. Buffett and Mr. Bogle.
Okay. Anup, you haven't narrowed down on one person. I mean, when we were having an investor camp once, we asked this same question to investors, and one expert told us that the person who actually I've gotten influence from is my wife, because every day when I go back home, she has a new set of demands for me. So I have to go back and create that kind of wealth for my investors so that I can bring it back home as well in my salary. So if you had to narrow it down on just any one person, any names that you can give us?
Are you asking me?
Yeah.
Okay. Yeah, I mean, I guess, the biggest guru of all is Warren Buffett in a way.
Yeah.
And everybody's learned a lot from his readings, and not his sayings are everywhere. His one-liners are remarkably deep and very insightful. So I think I'd have to say above everything else, he's obviously been the biggest influencer of a lot of investment philosophies globally.
All right. Well, we could have carried on for another 2 or 3 hours, but that's the limited time that we had at our disposal. So, gentlemen, thank you so much for taking time out and talking to us. And Sonia, it really was a privilege for us to, talk to so many mutual fund managers and learn so much from the kind of experience they have had.
And not just about their professional careers, but how they manage to handle all the chaos in their personal styles as well, right, Anuj? So thank you everyone for joining us. And there's, of course, an action-packed lineup for the next many hours. So we will be tuning in as well, and we'll be a part of some of those sessions. So thank you, all of you.
Thank you.
Thank you.
Thank you, panelists, for that engaging discussion, and Sonia and Anuj for moderating it. We'd like to quickly move on to the next on our event. Our theme being Future Ready, I'm happy to invite S. Naganath, President and CIO, DSP BlackRock, to deliver the keynote address on how we can all be future ready. Please put your hands together for S. Naganath.
Morning and a warm welcome to all of you. Thank you for the opportunity, Cafe Mutual, to deliver the speech on being future ready. 2 things to note before I start. 1, the speech will be very short. 2, many of the points I make are very well known to you, so all I'm doing is simply reiterating what you already know very well. So, when Prem said, please speak about this topic, I was sort of mulling over it, and I've come up with 5, maybe 6 points that I'd like to articulate to you today, this morning. The concept of being future ready is as important to you as it is to your client, right? So when you look at yourselves as intermediaries, you're performing a very important function, that of guiding your clients to take the right financial decisions and helping them secure their financial future. I think that phrase is very important. Now, there are many approaches to business in any field. We all know that. Some of you may be approaching business in terms of seeking transaction volume. Some of you may take a more steady-state business builder approach. No matter what the approach, I think if there is clarity in your minds, and therefore that clarity is then transmitted in the course of your advisories to your client, I think that's what makes for a successful business model. The key, I think, for customers is to receive advice which they value, which they see as consistent, and which they see as helping them achieve their objectives, which is, as I mentioned earlier, a secure financial future. So in the context of all this, time and again it has been said that financial planning is very important, absolutely no doubt about it. Understanding the client's risk, appetite, return expectations is very important. Therefore, preparing a financial plan, very important. Some of us, may do it in a very focused manner. Some may not do it. But I think it's very important to ensure that this is done at the very outset so that the client and you, are in sync in terms of what is to be expected as time evolves. The other point I'd like to make is that as time progresses, it's important to evaluate what has been done with regard to client portfolios. And this is where I think, the power of compounding is important. Now, all over the world, we're finding that one of the biggest challenges in front of investors is how to prepare for retirement. Longevity is increasing, so the number of years spent after retirement is increasing. And if you need to provide for the post-retirement years in a comfortable manner, it is important to plan well ahead of retirement. Now, the power of compounding is very well known to us, the construct arithmetically, we all appreciate it. But do we really implement it? Do we really understand it? Do we really evaluate it in the course of evaluating portfolio outcomes? I think that's a question we all have to ask ourselves. Perhaps we don't pay enough attention to it. Sometimes we do, sometimes we don't. When I read about fund managers in the developed markets, the press might say over there, here is a fund manager who delivered a 20% per annum compounded return over 25 years. What a fantastic rate of return. And then I look at some of our own equity mutual funds, which over 15 or 18 years or 20 years have delivered similar rates of return. I don't think that is celebrated often enough by all of us. These are fantastic rates of return. And when you look at the compounding effect of all of those funds in terms of the returns generated, I think it's fantastic. So appreciate the power of compounding better, and more importantly, articulate it to your own customers so that they better understand the importance of staying the course and deriving the best from the compounding that a good portfolio can offer to them. The other is that we're all staring at the possibility of slower growth across the world. You see the recent decline in commodity prices. I think it is telling you something. It is telling you that growth in the big economies is sluggish and perhaps will remain so for quite some time. Otherwise, there is no reason why commodity prices should decline so rapidly as they have in the past year or so. Now, we're all familiar with an inflationary world where you have inflation every year. Asset prices also respond positively in many segments of the markets to inflation. Nobody really has encountered disinflation or worse, deflation. That was last seen many decades ago, the height of the Great Depression, and so on and so forth. So the key really is, should there be a period of sluggish or subpar growth globally? And if indeed you have issues of deflation creeping up, what does that do to rates of growth? Obviously, rates of growth will decline. Expectations of return from many asset classes in terms of the returns that they can deliver will decline. That poses a challenge for you as intermediaries in terms of advising your clients on the appropriate asset allocation, right? Because you have to achieve a certain rate of return to maintain lifestyle. That's what the customer will tell you. How do you then best do at a time when the potential for deflation reduces the likely returns out of either the equities asset class or the fixed income asset class? So that's something to ponder about, but this is not something to be dismissed as academic. I think these issues will be front and center over the next many years in financial markets globally. The other point I want to make is about debt versus equity. The common paradigm again is, as you get older, you invest less in equity because it is seen to be risky. I would say question that. If I'm 60 years old, looking to retire, I have built enough financial security, why should I not invest more in equity? The standard of metric of 100 minus your age should be your equity percentage allocation. My simple question to you is, why take it as an accepted fact of life? Why not challenge that paradigm? If the customer has the risk appetite, has set aside enough money for financial security to take care of all requirements, and still has, enough and more savings to be able to deploy in the markets, and if the equity market environment is conducive and the risk appetite of the customer is in place to buy equities, why cannot the customer look at a higher weightage for equities? So in the context of, I think, asset allocation within the portfolio, I think you as intermediaries need to consider this paradigm of equities versus debt in the context of the investor's age and relook at that one more time. Two other points before I wrap up with a quick market outlook. One is on risk management. Again, oftentimes I have noticed in the markets that investors focus on returns. Less is made of risk, and perhaps it is important that you as intermediaries focus on risk-adjusted return profile of any and every investment. Oftentimes, the returns focus tends to lead to misallocation of capital, and then when the risk kicks in is when the investor says, well, you never told me about this. So I think it's important to tell investors that every investment has some risk, sometimes less, sometimes more, so that a more holistic view of the return that can be derived from that investment is appreciated by the investor. So the concept of risk-adjusted return ought to be brought into every conversation when it comes to investing. Lastly, I think there's been a lot of talk lately about more and more technology and data analytics in the context of investing. And in the West, we're seeing a lot of new algorithms and all other new kinds of approaches to delivering investment advice. So at various seminars, people have talked about the potential competitive threat that can arise from these new advances in technology in the area of financial services. My own view is it's too early. Let things evolve. I personally believe that in the area of financial services and advising customers, trust is a key element between you and the customer. If the customer believes, like I mentioned earlier, that you can deliver value-added advice, that advice comes through consistently, that advice is very crucial to the customer being able to secure his or her financial future, that business is not going anywhere. It's coming to you. So I think so long as that trust element is maintained and solidified and enhanced year after year, you need have no fear about losing business to a technological platform. Let the algorithm, prove itself over time. Maybe many, many years down the road, it could prove to be a competitive threat. But so long as you and the customer have that bond of trust that is born out of years of solid, consistent, good advice that helps the customer meet their financial objectives, I think your business is secure. Lastly, a quick word on market outlook, if you're interested. I think, we've seen some volatility the last 2 or 3 months. I think we'll see more of it in the next month or two globally. I don't think the competitive currency depreciations are done yet. I think there is still some more to come. That will continue to roil the markets for another month or two, in my opinion. After which, I think the volatility will subside, and you will again have the uptrend resuming. As far as India is concerned, we are not immune to this global market volatility, so we'll have to sit through this period of volatility. But we're in an exceedingly good position as an economy to take full advantage of the decline in oil prices, decline in commodity prices. Our growth rate of 7% in terms of GDP growth is an excellent rate of growth in the context of worries about deflation, where growth rates are much lower elsewhere. So I think all in all, after the current phase of volatility subsides, I think our markets will do exceedingly well, in my opinion. Investors ought to take a 2-3 year view, not just a tactical 1 month or a 3-month view. And it's your job as intermediaries to sort of get them to take that medium to long-term view. Earnings growth for companies, we believe, will improve by the December quarter and into 2016 and 17. And even the growth momentum in the economy will be fairly visible, I believe, by the time we get to the December quarter. So sit through this period of volatility.